Hi everyone, I am Fakrizzaki Ghazali, Head of Fixed Income Strategy at RHB Group. Our topic for today is opportunities from rising yields in government bonds. Rising inflation risk from high energy prices and improvement in job markets has led the Fed to believe that the economy is on the right track for recovery and the need to dial back the easy monetary policy slowly. We believe the Fed taper will begin earliest by middle of November, with the bond buyback likely to end by middle of 2022. As a result, the benchmark US Treasury and Malaysia government securities yield for the 10-year rose significantly by 27 to 37 basis points since August to 1.57% and 3.56% respectively. We anticipate yields to remain volatile in the fourth quarter of this year, with target average yield of 1.35 to 1.7% for the US Treasury 10-year and 3.4 to 3.5% for the MGS 10-year. We expect bigger supply pipeline of MGS and GII in 2022 in anticipation of refinancing requirements and to fund government's development expenditure. Under the recent announcement of 12 Malaysia Plan, the government proposed development expenditure has increased to 400 billion ringgit for the period from 2021 to 2025. As for next year, our baseline forecast for total gross issuance of MGS and GII will be at 168 billion ringgit, a slight increase of 3% from 162.5 billion that we expect for this year. The government has issued total of 131.5 billion ringgit of MGS and GII on a year-to-date basis until the week ended October 15, with 7 more auctions to go until the end of the year. We maintain our total gross issuance target of 160 to 165 billion for the government bond this year, as government has secured approval to increase the debt to GDP ceiling to 65% from 60% previously. We view foreign investors' appetite for ringgit government bonds to remain solid despite mild net outflows of 216 million ringgit seen in September, driven by selling pressure in the emerging market bonds as a result from the prospect of US tapering and rising inflation risk from higher oil prices and credit risk posed by the Chinese bonds during the month. Overall holdings of MGS fell marginally to 25.1% in September from 25.2% in August. On a year-to-date basis, total net inflows reached 23.7 billion, which has exceeded last year's net foreign inflows of 18.3 billion ringgit. We see domestic aggregate surplus liquidity to stay robust, with the banking sector's holdings in MGS and GII rose to 32% in the second quarter of 2021, followed by EPF and foreign investors. Other financial institutions could also increase their investment in government bonds from their low-base positions, as yields becoming more attractive. While secondary trading activities have been lackluster so far this year, we anticipate rising market volatility to drive transaction volume in the fourth quarter, which shall increase market liquidity as well as increase allocation to local currency emerging market bonds could spill over into the Malaysian bond market. In summary, we believe that domestic liquidity will continue to anchor Malaysia government bond market, while foreign investors to provide significant support amid rising supply estimates as governments continue to prioritize on the economic recovery and the well-being of Malaysians arising from the scarring effects of COVID-19. Thank you for listening to the podcast. Have a good day and stay safe.